Welcome to the debate. Look at this. Walgreens is paying 9%. That is basically free money.
It is not free money. It is a trap. I was tired of guessing, so I wrote 50 lines of Python code to scan the entire S&P 500. Look at the dashboard.
A trap? Come on. I mean, it's Walgreens, a household name, a dividend aristocrat. When I see a 9% yield, I'm seeing a deep value opportunity, a paycheck. Why would I walk away from that just because you wrote a script?
This is not an opinion. I fetched real historical data, so there are no assumptions, just calculation. I'm showing you this calculation to teach you how to analyze markets like a professional, so you can make your own decisions. In the next 6 minutes, I will show you the exact Python logic gates that separate dividend traps from survivors and the 3 stocks that passed.
Okay, I'm listening. But you have to see it from the human side. People, investors, they rely on these big companies. They have history. You call yield a trap, but for most of us, yield is the entire point. It's income.
Yield is a distress signal. You see how yield as generosity. I see it as a company screaming for capital because its share price has collapsed. Walgreens, they cut its dividend to 0 in January 2025. That 9% yield vanished, and the principal fell 56%. Debt. Opioid litigation. Opinions are noise. Code is truth.
Fine. If opinions are noise, show me the system. How does this code of yours actually work?
We start with a system boot. I am not reading news articles. My script connects directly to the NYSE and NASDAQ APIs to fetch raw balance sheets. We bypass the pundits and go straight to the financial organs of the company.
Okay, so you have the data, but how do you filter it? There are 500 companies in the S&P?
We use 3 logic gates. Logic gate 1 is the income floor. I filter for a yield greater than 3.0%. The average S&P 500 yield is only 1.06%. That is not enough to live on.
Greater than 3%. Wait, hold on. But strictly applying that filter just eliminates the biggest growth engines. What about Apple, Microsoft? You're cutting out the very companies that have driven the market for a decade.
They are rejected. We need cash flow now. This gate instantly eliminates the low-yield tech giants. We are looking for serious income only.
All right, so tech is out. We're left with the high yielders. But you just said high yield is a trap. Isn't that a contradiction?
It is only a contradiction if you lack logic gate 2. The safety gauge. This is where we filter for a payout ratio of less than 50%.
Less than 50? That seems incredibly strict. I mean, entire sectors, utilities, REITs, they're designed to pay out 80–90% of earnings. If a company's friendly to shareholders, shouldn't they pay out most of what they earn?
When I was working as a fintech engineer in a hedge fund, we did not look at yield. We looked at solvency. High yield is just a distress signal. If a company pays out more than 50% of its earnings, it has no margin for error. That is what happened to Intel. Borrowing money to pay dividends while trying to build factories, my code rejects that. We demand companies that can pay us and still have half their money left over.
Okay, I see the risk management angle there. You want a buffer. But if you demand high yield and high safety, aren't you worried about inflation just eating away at those returns? High-yield stocks are often dead money.
That is why we have logic gate 3, inflation protection. I demand a 5-year dividend growth rate greater than 8%. We need companies that give us a raise every single year faster than the Federal Reserve can print money.
So high yield, low payout, and massive growth. That sounds like a unicorn hunt. I mean, does anything actually survive these filters?
Most do not. The code builds a graveyard. It rejected Intel because the dividend was suspended. It rejected 3M due to litigation risk. It rejected Walgreens for debt. It even rejected AT&T and Verizon.
Whoa, hold on, AT&T and Verizon. But those are utilities. Everyone has a phone. They're supposed to be the safest stocks in the world.
Rejected. Their debt loads are suffocating their cash flow. You see them as safe utilities. The math sees them as insolvent debt instruments.
So what's left? You scanned 503 companies. Did anything pass?
Only 3. Out of 503 companies, only 3 passed all gates.
Just 3? All right, let's hear them.
Survivor 1, Target, ticker TGT. It has a 5.0% yield and a 52-year history of payments. Survivor 2, Hormel Foods, ticker HRL, 4.8% yield. It is recession-proof protein. Survivor 3, Kimberly-Clark, ticker KMB, 4.2% yield. Essential goods, tissues, diapers.
Target, Hormel, and Kimberly-Clark? I have to be honest, that is an incredibly boring list. We're talking about groceries and toilet paper. Where's the alpha?
Boring makes you rich. Excitement makes you broke. You wanted excitement with Walgreens, and you lost 56%. These 3 represent solvency.
Fair point. But does boring actually perform? Or are we just, preserving wealth without really growing it?
I ran a backtest from 2014 to 2026. The TRAPS portfolio, stocks like Walgreens and AT&T, it lost 12%. The code portfolio gained 148%. It beat the S&P 500's return of 130% while paying 3 times the income.
The math. Wow, it's undeniable. A 148% gain versus a 12% loss. I think I need to delete my Walgreens order.
Stop guessing. I have uploaded this exact Python script to the description. Download it, run the scan yourself. Next week, I am building a bot to track Warren Buffett's cash pile. Subscribe so you do not miss the code.